help our members, our clients, to make the difference and to be prepared for the future climate risks. So from the last year's data, AIB has been doing very well, on the good track to achieve our 50% climate finance percentage as set out in our corporate strategy. We achieved 56. The number itself looks, it is remarkable. That involves a lot of effort. But we also want to be very kind of open and candid by also sharing that within this 56%, the majority or the large majority is still climate mitigation. And then for our climate adaptation, it is only about, I think, around 20%. So there is still a long way to go. And then that is the path that we are trying to explore and then to increase our solutions in this area. And in the meantime, we do have some achievement, right? We do come here with some solutions and to share with the others. One of them is the first Asia Climate Adaptation Bond that the bank has issued. So therefore, that is one of the topics that we want to focus, because this is one very important instrument and a product we think can help with this issue, but the market itself somehow is not kind of picking up sufficiently. So therefore, as I mentioned and emphasized again, let's focus on the practical solutions, pragmatism, and to share and to talk about this topic today. So with this background, we have a very great panel for today to share about the practice and the experiences. So we have Sean from the Climate Bond Initiative, who is the CEO of the CBI, and then who is going to be the first speaker. And then Sean will be followed by Darren from AIB's Treasury, is the head of the funding team. And then our Julia, our climate specialist in the climate team. And lastly, we also have Peter from who is the senior policy advisor on climate finance of the Ministry of Finance of Kenya. Okay, so thank you very much. So I will just leave the floor to Sean to begin with. Thank you.
Well, I might just say he is so comfortable in this chair. If anyone wants to join me on stage, please do. It's great. I'm here because AIB has issued a climate resilience bond, and because the Climate Bonds Initiative, which is the CEO, is driving global development of this thematic market. I would just want to say two things up front. A, it's fantastic that AIB has done this, and we celebrate, support the issuance, and hope we see a lot more. And two is, it's important to understand this is a subset of the broader climate thematic investment. I say that because we have built demand for green-themed instruments over the last 10 years. We now have $4 trillion outstanding of them. There is liquidity in this market, and for pension funds and insurance funds that are our primary target audience, liquidity is everything. If they feel they can cash in a bond to pay your pension when you retire, they're attracted. If they can't cash it in, it's much harder to invest in. So we want this market to be an extension of the existing market, not seen as a silo. Very important, and that's what's happening so far. So it presents us a great opportunity to educate investors through bond issuance about these other things that we need to do around climate beyond just investing in solar and other renewables. And it gives us an opportunity to signal to the rest of the world where activity is happening and what kind of activity. So let me step back for a minute. You know about the fact that we have failed on climate change because the World Meteorological Organization says we're going to get 1.5 degrees Celsius warming in 2027. That is, by the way, the official G20 maximum warming target as adopted last November in Indonesia. So we have a problem. We are entering into a period of severe climate change. That is impossible to avoid now. The race we're on mitigation, which is to reduce emissions by 50% by 2030, 6 years to go, is about making sure we don't go into catastrophic climate change. Climate change in which no amount of resilience work will be useful. We need to understand this. The stakes are very serious. We cannot let up on the mitigation agenda. In fact, we have to drive it harder and faster. There is no doubt amongst global investors that the future's now been decided. It will be green, thanks to the IRA, thanks to China's extraordinary investments in renewables, thanks to the GX plan in Japan, and so on. The question is now the speed, and who will be the winners and who will be the losers. There's a tsunami of change coming through the world economy, as we see already in renewable energies, as we are beginning to see in the daughters of renewable energies, hydrogen, ammonia, electric vehicles, etc. But there's a lack of appreciation of the extent we also have to make sure that this future we are crafting, we are building, we are generating is resilient. We could make some bad choices. We are still making bad choices. We know we have to prepare for substantial physical change in our world. With the potential collapse of the Greenland ice sheet and the West Antarctic ice sheet, actually the West Antarctic ice sheet is basically gone. The only question is the speed. We know we have sea level rise, much more severe than we had been predicting. Well, that's a simple thing, right? We need to raise the height of our wharves. Singapore is already doing this. The new port in Sihanouk Vul in Cambodia is creating wharves that are high enough to deal with sea level rises. Fantastic. Our existing ports in Hong Kong, in Japan, need to be retrofitted and renovated. But it is so much more than that. Water. Drought is going to become the norm. In Sichuan last year, we saw drastic drought. The Three Gorges Dam was not operating properly. At the same time, we saw 50 degrees Celsius heat across Sichuan. Massive demand for air conditioning. There was a power crisis in China. You can sort of see the sort of things we've got to do. We have to make sure our water infrastructure is more resilient and able to survive ups and downs way more than we've been planning in the past. We need to make sure our energy system and our grid is hardened to survive peaks in these heats. We need to make sure our air conditioning is much more energy efficient, because over the last 15 years we have installed more air conditioning capacity on the planet than renewable energy capacity. This is a disaster. But at the same time, we need that air conditioning. I know I can't survive Sichuan in 50 degrees Celsius heat, let alone anyone who's living in Chongqing. And our clean water. Our clean water, we need it for development, but we also need it because as we have a crisis, we're going to be using a lot more water. Drinking water is going to become scarce. We've got to have access to it in places like Kigali, Abuja, Najami, and Chad for that matter. The infrastructure that we have to develop in this area is massive. It's important because when there's a crisis, if that infrastructure isn't available, people will die. Mortality rates are going to go up anyway. That's the nature of the era we've gone into. The climate change impacts that I'm talking about are certain. They are not speculative. Remember that we have a 30-year latency effect in global climate systems. If we stop emissions cold globally tomorrow morning at 9 a.m., we will continue to warm the planet till 2050 before things start stabilizing. That's the way it works. So we have to prepare. Heat is the thing that worries me most. Sichuan last year was a classic example, but it wasn't just Sichuan. It was Sicily. It was Southwest USA. It was Uttar Pradesh, where we have seen elevated mortality rates, and we are going to see significantly elevated mortality. What does that mean? Well, it means our buildings need to be built differently. Thermal insulation has got to be there. We need that air conditioning I mentioned. We need to make sure that we're doing this while not inadvertently making mitigation harder. That's the reason for super efficient approaches to thermal insulation. And across Africa and across Latin America and across South Asia, this is a material issue right now. Storms in East Asia, typhoons are going to become twice as intense. And Shanghai is becoming a typhoon zone, which it never was before. There's been a couple already. That's going to mean different approaches to resilience, to preparedness to be able to come back after a storm. But it's more than physical. It's social, because all of these things lead to incredible disruption of our people, our populations. You know, there is a direct correlation between the strength of communities, between cohesion of communities and lower mortality rates in crisis and better recovery rates. In research done in California around earthquake resilience, some 40% of the reduced mortality rate you might get in different communities is because the strength of the community. Investing in creating stronger communities leads to better resilience. From an investor perspective, and my stakeholder group of global investors, it means lower default risk. It means communities can be better able to pay back their debt if they can get back together and start being productive again quickly. So we need to invest in stronger communities. The city of San Francisco funds neighborhood block parties to ensure that people know each other. So when a storm comes through or an earthquake, they will save each other and look after each other. That's a clue. The education of women is a climate resilience activity, because we already know that when you educate women at a primary level, they go on to start businesses. For central bankers, as I keep telling them, women dominating small business leads to lower default risk. Typically, the default risk for women in microfinance is 3%. The default risk for men in microfinance is 20%. Get the men out of it. Put women in charge is the way of making our financial system more resilient and making our societies more equal and able to bounce back in a crisis. You can sort of see where we need to go with this. This is the SDGs, everyone. The Sustainable Development Goals create greater resilience in our societies and reduce default risk for global investors. That's the argument we need to make now. We need to make sure this is a smooth transition to preparedness and to mitigation, because if not, we're going to have blowback. Think the Gilets jaunes in Paris. Unless our policies for change are inclusive, we will get fight back and we will get setbacks. So a just transition is part of climate resilience, but it's way more, it's health. You know, in the 1600s, we saw significant climate impact as a result of depopulating the Americas in the 1500s. With smallpox and measles, we killed off 95% of American Indians in that 100 years, the 1500s. We now know. The forest regrowth in Central America and in the South America was so strong, we can now tell from carbon ring research, that it drew carbon out of the atmosphere and the planet cooled by 2 degrees. In the 1600s, as a result of this severe climate impact, we saw 3 things happen: war, famine, and pandemic. We lost a third of the world's population between 1500 and 1600. There was a collapse in population around the world. That's what happens when we have severe climate change. That's what we are facing globally. Pandemics are part of this. So preparing a health system which can cope with crises, hopefully we're learning for the last 4 years, is part of climate resilience. There's so much to be done. The opportunity with finance now, because we have investors concerned about forward default risk, material risk, is great. They are looking for investments today that can meet the risk yield requirements, but also address long-term risk. They really want mitigation investments. The green bond market has gone through the roof at $4 trillion outstanding now and continuing to grow. It's gone into green equities. It's gone into green loans. In China, there were 10 times as many green loans as green bonds, and China is the world's largest green bond market. Adaptation is a simple extension. When I used to talk to my friends at BlackRock 6 years ago about adaptation bonds, they would say, no, 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 no. We just want mitigation. Now, because of the demand from their clients, they're happy to say, give me adaptation bonds. I want them so I can put them in my green portfolios. We need demonstration issuance to show the way. That's why the AIIB's resilience bond is so important. Demonstration issuance to the market. It's not complicated. We need investments that meet a number of key criteria. Either they're about new capex to deal with resilience, think about new ports that are prepared for increased sea level rise and storm surge. They are about changing the procurement of existing investments, buildings. They are about renovating infrastructure to make it climate resilient, think water, and flood protection, or they're about refinancing investments that are already now consistent with the new rules. In many countries, rail companies, like in Japan or Australia, have been already dealing with resilience for the last 10 years. They should be part of this because we need the world to understand what is a qualifying green investment already out there. About 7% of the thematic bond market is already resilience bonds. AIIB, EBRD, the Netherlands has issued a sovereign resilience bonds. Cape Town has issued a resilience bonds for water, but only 7%. In a market which we expect to be in the tens of trillions of dollars in the near future, we need 50% to be identifiably related to resilience. That is a massive growth. There is guidance around. We are developing with UN Disaster Risk and Reduction a climate taxonomy for resilience, the kinds of investments to qualify. We are hoping, expecting, planning to collaborate with AIIB on that work as well, along with other development banks like IADB, ADB, and so on. We need to get this guidance out there, and we need to link it to the emerging pool of incentives. Multilateral development banks have announced this COP significant new initiatives around supporting green finance. There are new initiatives around supporting bond issuance in this area. Adaptation is part of that universe. AIB has shown us that already, but we need a lot more. It's a huge job we have to do. We are lucky there is something we can do to grow this market. As you know, most people are just going to be takers, receivers of the crisis. We can help promote the action required. We are lucky we have that privilege, but there is so much to do. Thank you. Thank you for the work you're doing in this area. Over to my friends.
I'm going to stand to speak, if you don't mind. A little more comfortable, and I can see the screen, another advantage. So I'm Darren Stipe, the head of funding at AIB, and I wanted to first introduce myself a little bit by saying that I grew up in the United States in the city of Missoula in the state of Montana. It's in the Rocky Mountains, and the reason my family was there is because my father was working as an entomologist for the U.S. Forest Service. His job was to protect the forests of the northwestern United States from insect infestations. So he devoted his life to that effort. And now you see, my father's retired now, the threat to the forests of the Northwest in the Rocky Mountains isn't so much from pests as it is from the changes that have come about due to climate. And specifically the threat of forest fires. So many of the forests that my father spent his life protecting are now burning down each year. There seems to be another very severe forest fire in that region. So I mention it to say that the topic of climate adaptation is personal to me. It's personal to you as well. I'm sure every single one of you can think of an example from your country, from your city, from your employer, or from your family where you've been already directly impacted by climate change. So climate adaptation is something I take personally and seriously, and it's something that we're seeking to address at AIB. And so today I wanted to walk you through a very specific example of our climate adaptation bond to give you a sense for how we're addressing it in the capital markets in terms of capital mobilization. And so we're going to get into the transaction that we did this year, and then also give you some details on how that transaction has really meant change, tangible change in the areas that we focused on geographically. I want to say that what makes climate adaptation finance work is efficiency on our part. So there are so many stakeholders involved in addressing climate adaptation. A development bank has a role to play, and the role really involves an efficiency that I'm talking about in the capital market. What leads to the efficiency? First of all, we're a AAA rated institution, so we take credit risk off the table. So for an investor in one of our bonds, it's not credit risk is not a factor. That makes the evaluation of the transaction very straightforward. We also have internally the policies and processes in place already to evaluate the projects that are targeted by the transaction. We have at AIB an environmental and social framework against which all of our projects are evaluated. So that is already in place for us. It makes it efficient for us to take projects on and to finance projects. We issue all of our bonds under Sustainable Development Bond Framework. Again, from an investor standpoint, make it very straightforward. All of our bonds finance sustainable projects. All of our bonds are sustainable development bonds. So we're making it as standard and as efficient as we possibly can in the capital markets. That lowers cost and attracts investment. This is why we say it's important that we say all proceeds are allocated to investments that support climate adaptation within themed bond, because it's a subset of the broader effort that we're making. So of course we do investment in climate mitigation, in the climate adaptation themed bond. We made sure that all of the proceeds are going to climate adaptation related projects. We also aimed with the transaction not just to finance the projects themselves, but to increase awareness for the theme of adaptation, because our sense is that a lot of attention is placed on mitigation, rightly so, but adaptation is as important. It gives the investors a chance to engage in climate financing, especially on the adaptation side, of course. Many investors are looking for ways they can invest in climate. It's not so straightforward. Investing in AIB bonds is certainly one of the ways. It brings, as I said, visibility and recognition to the topic itself, especially as it relates to the goal of the Paris Agreement. And it also supports the positive impact of AIB's ESF and environmental and social risk management. So that's important to us as an institution. So the transaction itself is one that we denominated in Aussie dollars. That's because a lot of the investors in Australian dollars do appreciate thematic bonds. It's not necessarily the case for every denomination. It's especially true, we find, in Aussie dollars. So in our sort of inaugural thematic bond, we did target that currency specifically. The transaction went well. So we issued 500 million Aussie dollars. It was a 5-year bond, oversubscribed by about 2 times. That means it attracted a lot of investor interest. One thing I think is interesting is that the distribution by region and investor type says something about the efficiency that I'm mentioning here. And that is that if we look at that bottom donut, the distribution of who bought the bond, you can see that central banks and official institutions were about half of the orders that we received in that bond. Bank treasuries, another 27%, I think the number. The rest were asset managers. So of banks and central banks, I would say they lean towards having ESG criteria in the way they're investing, but oftentimes they don't have strict criteria. So they're interested and they like it when there's a climate theme, but it's not necessarily required. Within the asset managers, that's where you get a lot of the investor interest. Is very specific. So they either have a strict mandate or they have reporting requirements that make it much more important for them to be investing in climate-related bonds. So I say that because what makes the trade successful is that there's a financial component that attracts investors, and that complements very well with the climate theme that ultimately is the target of the transactions. We can make investments in real projects. So those two things are fitting very well together. That's the efficiency and the advantage of an MDB issuer. So you get that AAA, already a global investor base that's attracted from the financial side, and the ESG investor also attracted. All those things to come together to give the pricing the tightest level. So with more investor interest, we price the bond more attractively. And then we get the type of investor participation that really makes it a successful bond. So we need all of those things working together. That's what happened when we did this transaction, and that's what we'd anticipate happening as we go forward in time. So the transaction having been done, what comes next? We want to be very transparent to investors on the impact of their investment. And we're adding to our impact report, starting in next year's report, the type of information that investors would expect about the adaptation bond. So we are specifically going to be disclosing at the project level, the portfolio level, number of projects, total committed amounts, the adaptation finance amount per project, and the allocated amount, and total climate adaptation theme bond outstanding. That's to say, if we issue more bonds of the same theme, we'll have the aggregated reporting as part of our impact report each year. In the way we designed the bond, we required projects to have a minimum of 20% or greater of the total project financing as something that's considered to be in the allocation of proceeds. So the project had to have at least 25% component that was climate adaptation related. So we're very strict about the way we were counting the projects that will be involved in the use of proceeds. And as I say, that type of detail is going to be included in our impact reporting going forward, so you'll see it starting next year. We allowed two categories of climate adaptation activities to be eligible. One is investment enabling adaptations. So you can think of it as a project that's directly targeting adaptation itself. The other one, adapted investment, where the investments and assets aimed at integrating adaptation measures are to manage physical climate risks identified for the project to ensure that the intended objective of the project are realized considering possible climate risks. So it's more about the risk side. So is the project considering and factoring in climate risks in the way the project is designed? So both of those can be eligible to be involved in our use of proceeds. AIB's commitment to the Paris Agreement is formalized this year. As of July, all of our projects, our new projects, are Paris aligned, and that is also another complement and part of what I view as the efficiency. So again, all AIB projects are sustainable. Now all AIB projects are Paris aligned. You set that as the overall standard, and then the climate adaptation projects specifically are very transparently, I think, aligned to what an investor would expect in terms of the type of impact their investment should be having. And then I wanted to get into a couple of examples of the projects that are being financed by the bond. And again, because I think it's important to keep in mind, these investments are very tangible. They come down to the personal level. They're affecting people, and they're impacting a lot of people. You probably remember the severe flooding that happened in Henan. And sometimes we get a little bit lost, I think, in the news because there are climate events all over the world all the time and a lot of news events. But this one was a severe one. Massive impact on Henan province, and then became a natural situation for a climate adaptation response. AIB's funding involves $1 billion US. Of that, $389 million were identified as being adaptation financing related. It's impacting 20 million people, and that's because it involves high population areas of Zhengzhou, Xinjiang, and Jiaozuo, and helps those communities in their interventions. So they are focused on rehabilitation, reconstruction of damaged infrastructure in water, flood management, urban, and transport. All of those things are now aimed for reconstruction in a long-term sustainable fashion. So massive impact, that particular project. Another one as important in India. The Punjab, it's a region that is highly exposed to climate risks. Our project there is to support that state's action. They have a state action plan that addresses climate change. They're particularly focused on management of water resources, and their project aims to improve the efficiency of water usage, control water pollution, and minimize wastage. In this case, of the $105 million AIB investment, $37 million was identified as being adaptation related. It's 20 water storage facilities built by the project. It's 3 million people impacted. So, which is to say, we can be optimistic in the sense that we can be efficient as a multilateral and fill our role in the financial markets to attract capital that will be invested directly into projects that impact millions of people. And we're going to keep doing this at AIB. We encourage investors continue to invest in AIB's sustainable development bonds. And we look forward to having an ever greater impact going forward in time. Thank you.
So that Sean doesn't feel lonely. Okay, thank you, Darren, for your elaborate introduction into the adaptation bond we issued just this year. The next presentation we want to focus on and give you a bit of an overview as well is on an investment framework that AIB has launched together with Amundi, which speaks about the bond issuances and kind of helps the bond issuers in the market to also understand how to address the Paris alignment related considerations. So this is a $500 million climate bond portfolio, like I said, which was invested back in 2020 with the Amundi asset manager. And as part of that portfolio, there was an agreement to set a climate change investment framework, which will help the issuers to also rate and rank and benchmark the issuers against their performance towards climate-related goals. So the framework is kind of a benchmarking tool, and it's also free and available to use not only as part of this investment that we did with Amundi, but for others as well. So it's sort of an educational tool as well, and it's already been used by some other fund managers and pension funds after our launch back in 2020. So what we did here is we've issued this framework 2 years ago, and then since then there was also a research and a stock-taking exercise as to how is it going for the issuers who are applying this framework. So what I would like to speak about is actually the results of that research and what we can find there in terms of how the adaptation related risks and impacts are being considered there. So a bit of a background on where we are and how it actually works. So there are 3 pillars that are kind of part of that framework. One is the transition of the company towards low emission climate resilient development pathways, and that transition metric or an indicator is measured by the company's amount of revenue that is directed towards green financing. So that's indicator number 1. There are a total of 3 indicators. Indicator number 2 is how the company is addressing the mitigation risks or transition risks for the activities that they do, whether they have any high carbon emitting risks in there. So that's the mitigation element of that. And then there's also an adaptation element of it, which is how the company is addressing the physical climate risks. So the framework comprises of 3 elements. It's its own transition to a low and climate resilient pathway, and how it is managing its own emissions, both scope 1, 2, and 3, and how it's looking into the physical risk management. So the research that was done last year by actually 3 companies, which is the Climate Bonds CBI, the Fitch Solutions, as well as Carbon Trust, and they had 3 areas they were looking at. One was looking at different sectors across the world. The other one was looking at the companies, and third part of that research was looking at the actual issuers of the debt securities. And so they were analyzing the three pillars against the climate change investment framework, and they've made some very interesting findings in this regard. So the first chapter, which was talking about the sectors, and analyzed a total of 8 sectors, which is energy, utilities, water, healthcare, buildings, materials, transport, etc. And in there, over 200 companies were analyzed that are working in this sector. And there was a consistent finding that the data availability is not really sufficient to kind of do a very comprehensive analysis, and that there are significant quality gaps and differences in performances against all of those companies in there. Now, there was also a second chapter which was speaking specifically on companies in 4 sectors, and there were detailed case studies provided of the companies that are working in this regard. And in there, there was also, they've seen that there is progress in terms of how they're addressing, for example, the mitigation pillar of it. However, when it comes to climate adaptation, not many companies had any adaptation plans in place or were considering physical climate risk exposure. So that's an interesting finding in there that again kind of underlines that when it comes to adaptation, not all of the companies across the world, and particularly in Asia and in emerging markets, understand the need to address the physical climate risk and actually put in place the plans to help them to support that. When it comes to issuers as well, very interesting findings there. You would be able to look into the report and see kind of an overview there. The issuers were ranked against, they were labeled in 3 categories. So the ones that are doing good, they were in the middle category. Then there were the ones that were performing very well, which were the so-called climate champions. And then the third one was the laggards, or the ones that actually did not perform well across all of those 3 pillars. So there are almost 500 companies that were analyzed, and you can see the findings in that report in more detail. But again, to underline there that only 14% of companies in those report actually had any adaptation plans in place. So it's really an area that requires significant improvement, and there's a lot of work that needs to be done there. So specifically when it comes to the climate adaptation planning and implementation, there needs to be some steps these companies should take to address that. So what is the conclusion? There were a few as well considerations that I think it's important to note here. One is that there are actually currently different regulatory frameworks and methodologies and policies that are launched by or provided by different governments that, for example, request you to consider physical climate risks. And so those companies that are operating in these specific environments and geographies then do address that, and those that don't have such regulatory requirement do not. And then there's also a very difficult data and inconsistencies in data across of all of these companies. There were some findings that, for example, for companies that have more stronger exposure to mitigation, or they're working in sectors that have significant GHG emissions in the utility sector and energy sector, those are the companies that are actually taking actions towards that and addressing this issue. And those who are not active in this space, like the healthcare sector, are less active in doing so. But nevertheless, it's a difficult research to do because of the reports or the analysis that you were looking at have different data points, and there is no consistent common standard that you can apply to actually compare those companies against each other. So it's really a challenging part of it. But when it comes to adaptation, you can see there on the slide, it's at the very, very far left end, which says that analyzing the performance against adaptation of the both companies and issuers, it's a daunting challenge, and it's still a long way to go. So in terms of the conclusions and next steps, there will be another report looking at this again from this year, because they were looking at the issuers from the portfolio previously, and then they will be looking at this again. So we encourage everyone to have a look. Once it's launched, it will be published on our website. I think I'll stop there just to give you again an overview where we are with the broader market and the issuers and how they are addressing the climate adaptation space. And with that, I would like to invite our last speaker, Mr. Peter from the Ministry of Finance, Kenya, who will share his experience on the work they do to issue an adaptation bond themselves as well. Welcome, Peter.
Thank you very much. My case is very easy. It's simply to share with you my experience as the practitioners, and also to see how we can build the synergy and move to the next level. One thing that I like most that from the previous speakers that have spoken, the first speaker really highlighted issues and the importance of adaptation. And adaptation is the key to investment today, tomorrow, and many years to come. I joined the Ministry of Finance in 2013, and by that time, all ministries of finance have got no embedded climate change unit or department. They are purely financial experts, economists, and all those. So at that time, it was very, very challenging for me to express to the people in the Ministry of Finance, budgeting, planning, and also to include any matters of climate change. The Ministries of Finance are designed in such a manner that because climate adaptation bonds is part and parcel of debt instruments. Debt instruments are always handled by the debt department within those ministries. And within the debt instruments, there are very, very strict regulations on how debt is managed within the Public Finance Management Act all over the world. With that, it was very difficult for me, and in 2016, I started engaging the highest level, showing them that Kenyan economy, 56% of the GDP is based on 5 sectors which are climate sensitive, including agriculture, water, tourism, forest, land use, and etc. It is at that moment that I started working on what we called then the Green Bond Framework in 2016. At that time, Green Bond was taking shape, but it was still very, very weak, and a lot has not been done. It took 3 years to convince the team that there is something on this side on how to adapt and on how to get resources to ensure that those sectors, including the infrastructure, including the energy that we had, which was about 75% hydro. Hydro is very sensitive to climate change. When there is no rain, there is no water in the dam, and then I was very able to link between the nature and those infrastructure, and by 2017, we had the first climate finance policy, which now clearly outlined the role of green bonds as a very strategic instrument for mobilizing in scale financial resources from the private sector to support the investment in those infrastructure. It is also happened to be that within the National Treasury, which we called the Ministry of Finance, I was also the National Designated Authority for Green Climate Fund. Now, those funds as provided for within the Paris Agreement are majorly small in scale, they are majorly grants, and they take a lot of time to get or access those resources. And when you get those resources, for example, within the GCF, within the Adaptation Fund, within the JEF, it is merely about $10 million for a period of 5 or 7 years. But it takes you another 3 or 4 years to get 10 million. And look at the adaptation gap. 2 years ago, adaptation gap and adaptation financing analysis indicated very clearly that adaptation is fully underfinanced. In fact, less than 30% of the total climate finance flowing globally is directed or channeled towards adaptation. Indeed, the last assessment landscape, climate finance landscape report, which was released by Climate Policy Initiative late last month, indicated clearly, although there is some significant improvement in the flow of climate finance from the then about 870 billion US dollars to the current 1.37 billion, less than 30% is directed to adaptation. That landscape report links with the Kenyan climate finance landscape, which we released in 2022, of which we analyzed our budget on 2017-2018, and of the $243 billion that we have been investing in those infrastructure-related investment, less than 28% was the money which was channeled to adaptation. Yet, we are living in a warmer earth. We are living in an earth that today it is extreme drought. You channel all resources to respond, to mitigate or to respond to the drought. Then tomorrow, it is extreme floods. Then you reallocate resources to respond to the destruction of the infrastructure, the livelihood system to respond to flood. Now, when you look at the two, the hand sides of the coin, then you find that the resources that are being channeled through development is not there. It is on this accord that I am very, very grateful, and I'll be here, that the investment bank has already started something and has realized that it is business to finance adaptation. It is business, it is good business to come up with new frameworks for adaptation financing. Because adaptation, the infrastructure, for example, the ports. In Kenya, we have our ports. Those ports, the harbor, are all vulnerable to climate change. If we have to know that in the next 20 years, by 2030, the ocean level will be rising by 5 meters above the sea, it now means that all those infrastructure along the coastal line will be submerged or will be affected. And if they have to be affected, then it means that those assets are zero balance assets. But does the banks realize that? Do we invest in analyzing what we call the climate risks? Do we know our balance sheet of what we are keeping in our strong room? They are worthless. If climate risk analysis is set, then those assets are worthless. But when we come now in, climate adaptation bond is significant. I'm very happy that when we were here with the team, my finance minister, my minister for environment, from the 2016, they now saw it, that it is very, very critical. Adaptation and green blue bond is the way to go. And last year, with the World Bank, we, Kenya now, because I passionately like what I've had here, I'm adaptation-centric. Because mitigation centricity, as just the data shows, is very simple. It has been cracked. It is working for the balance sheet. We don't need to spend time, money to that what we know better. We now need to spend time, skills, and resources in what we don't know, if we have to continue and maintain the earth. And that is why I came here. To give you an example how things are changing, 2 years ago, we started in Kenya to come up with what we call Financing Locally Led Climate Adaptation Initiative. That one was because of the 58 million Kenyans population, nearly 45%, 80% are residing in areas which are very vulnerable to climate change. 2/3 of Kenya is ASAL area. So we decided to mobilize money for that. And by the way, the first multilateral bank to come to our aid was the World Bank. World Bank gave us $150 million to financing locally led climate adaptation. And how long did it take? It took less than 1 year to structure that financing. As a result of that, now, other development partners, the NEDA, SEDA, the government of Netherlands, the government of Kenya, with within a period of 6 months, overcrowded that 150 to another 150, and now that program is now having $300 million. The $300 million is now taken to finance adaptation support, which is led by the local communities themselves. They have the power to prioritize their own priority programs. It is only meant for adaptation to their resilience. So I think we are on the right track. We need to work with you because it is better to crack a new thing other than to run on things which people know. There is a say that create your own path and walk on your own path. And the outcome is that you will be successful. Because if we fail in climate adaptation fund, other banks will not follow us. They will abandon it. But have they not learned? Yes, they have learned that don't go there. See, that is positive. We have saved a number. But if we succeed with the adaptation bond, green bond and resilience, then more will follow the same track. So it is a good path to follow. But finally in Kenya, what we did, the challenges are, one, there is lack of capacity. People don't understand because they say it is difficult to have a bottom line for an adaptation project, to know what is the markup, what is the profit. Yes, it is true, but people must not be deterred with the lack of that information. Two, there is need for a creative, serious awareness among the financial institutions, the government policymakers, and also the people to know that there is a positive event on that. Three, there is still lack of technological support to ensure and screen that adaptation projects have got a value proposition for money. Four, there is need for reforms for the financial institution, for the government ministries, decision makers. What we did in Kenya when we came up with the green bond framework was first of all to go to the capital markets authorities and change the listing rules, change the guiding notes, and also change the law so that we allow in adaptation bond, resilience bond, green bond, blue bond, social bond. So we packed them there. But the challenge was then that the market is always not responsive. When it reaches a point when we wanted to go to the market was very bully. Bully how? The Moody's, with their rating of AAA, are not well understanding what this thing is all about, and they really confuse even the converted green investors. Those are areas where we need the reforms. If we have to go to this, then we really need to invest on our own adaptation bond resilient standards, which is allowable to the rest of the people. And finally, there is now a long queue on a number of institutions running to debt for nature swap, debt for climate swap, they are running there, but there is a vacuum. And for us in Kenya, we now say no. No financial institution will come to restructure our debt. We must come up with a framework for debt for nature swap, and all 90% of those swaps will be channeled through adaptation. We have made a decision. It is a policy decision, and I invite you, the investment bank, come and join us in this journey in the corner. Thank you very much.
All right, so thank you, Ari. Thanks a lot for our panelists. So I think we have heard different perspective and different experiences, which is I think quite informative. And then we have a little more time, I think, perhaps for one question from the audience. If you have any question that you would like to ask, just feel free.
Thank you. I have a question for Sean. Mr. Sean, can you explain a little, whatever you said, I agree strongly and very impressed by your passion and professionalism. But can you explain the role of your organization more specifically? How do you work with bond issuers? How do you work with investors and potentially government to make climate adaptation bonds a reality? Specific role of your organization. Thank you.
So we're an NGO. We're not a financier. That's these guys. We develop global rules. So in the green bond market, we've developed certification schemes, a climate bonds taxonomy in 2012, and then I was part of the People's Bank of China Green Finance Task Force that recommended a taxonomy and green bond regulations. I did the same. I was expert advisor to the European Commission in 2016, and we're now working on taxonomies around the world. At this COP, we've published taxonomies projects for Singapore, Rwanda, and Australia, tomorrow at least, and there are 40 others around the world going on. So guidance about what qualifies, and we're continuing to stretch the understanding of investors and governments about what qualifies. We work with development banks on that, because in the MDBs, there's a very good adaptation working group looking at rule sets and requirements and so on. But we want to take this to capital markets. We have $70 trillion of investors represented in our capital markets program. We also work on policy approaches for governments. What kind of policy approaches can we apply in Kenya that will help mobilize capital for climate resilience? And what's working in other parts of the world? We have some governments trialling things like Singapore is, or even in Cambodia, we're trialling some interesting rule sets now. And we work with growing the market. So our primary role is growing the thematic market, which is a way of linking investors with issuers and of underlying projects. So we provide data, we provide raw data to all the global indices for green bonds, et cetera, et cetera. And we work on things like the Climate Change Investment Framework, which we supported AIIB on, along with Amundi a few years ago, which is a particular framework for investment in Asia around climate change investment. So we do many things like that. But I want to stress, we're an NGO that works on systemic interventions that will help increase capital, including, by the way, interventions to reduce the cost of capital for green. Our primary objective is that we reduce differentially the cost of capital for green, including adaptation, so that in Kenya, when they're faced with how they finance things, they will be able to get reduced rates, preferential capital, greater access if they make the choice to do climate consistent, which they want to do, but we have to reward them, make it easier for them to make that choice. And that applies to every country in the world. So I hope that answers the question.
Okay, one more. There's, okay.
Hello. Hi. Hello. Can you hear me? So my name is Kavita Rai. I come from the International Renewable Energy Agency. About March, we were at the African Development Bank, who is working on adaptation benefit mechanisms. And they suggested that, particularly for energy and energy access, there's not so much of a headway, right? So they asked Irina if we could join hands and work together. So we have started coordinating. Now we have about 25 institutions trying to figure out what adaptation metrics for renewable, for renewable energy and energy access is. And I think I'm in touch with Julia. Hopefully the AIIB will join us too. All of us, including the MDBs, are really struggling. How do we count? How do we look at adaptation? How do we look at its impact? And how do we differentiate it and not double count with mitigation? Because all renewables are mostly mitigation projects. And I wonder, I would like to learn from your experience from Kenya, from the AIB portfolio, how, if you have energy projects, how do you do that? How do you differentiate, mitigation and adaptation and not double count it?
Thanks. Thank you, Kavita. I can respond a little bit perhaps on the adaptation metrics because we're part of the working group together with other MDBs where we share experiences, knowledge, and work on common frameworks. So in there, when it comes to adaptation metrics, indeed, it's quite particular on how we account, for example, adaptation finance what type of activities would be actually eligible as adaptation. And when it comes to energy sector, the transmission lines or the substations, for example, the capex part of it that is actually directly addressing the flooding issues or the extreme heat issues is something that we would then be accounting as climate adaptation finance. And then we would be including the relevant metrics if there is data available to account for that as part of our reporting. But for us to differentiate between adaptation mitigation and how to account for it, we then call that part of investment as dual benefits. So we explicitly say that this is the part of a project that will have both mitigation and adaptation benefits at the end. And when we report that as part of the joint MDB reporting into the report on climate finance each year, we then need to allocate that percentage to either mitigation or adaptation bucket. So that amount that is dual needs to be then disaggregated and not reported under the both. So there's always this area that we choose, and in order for us to make sure that we really account adaptation, which is already not a very well represented financing, we usually, the dual benefits one would be reported as adaptation finance, that specific funding amount. That's how we do it under our reporting. Maybe you would like to speak?
Yes, for us in Kenya, renewable energy depends on the type. For example, if you have renewable energy from geothermal, the geothermal itself, the steam itself and the equipment is counted within our green asset list as the technology for reducing emission. Because you tap the steam, the geothermal power, to reduce a clean green energy. So that aspect is counted as part of mitigation, emission reduction. The underlying infrastructure, including the upper catchment, the communities, the ecosystems, all are defined as adaptation. And within that adaptation, any support to that adaptation is linked with the resilience building of the communities, and again, the resilience of the technology, the machines, because there is always effects of the weather, environmental effects, and whatever around that machine. So we have a very clear demarcation between what fits into adaptation aspect, and what fits into the mitigation, because mitigation is the reduction of the greenhouse gas emission into the element, and then the technology that is allowed, that is using that, is counted as part and parcel of the mitigation. If, for example, we have the hydro, the upper catchment of the hydro, the river basin, the communities, the forest, support to those areas are counted as adaptation and building the resilience of this system. So the two assets are differentiated by the nature and the type of what they contribute. That is what we call cross-cutting matters. So, so in view of that, and with that distincting which is provided for in the climate finance policy 2018, and now we are coming up with green fiscal incentive policy, which is given on both mitigation and adaptation side, there is a very clear cut on that.
Is there time? No time. 2 seconds. By setting it 20% as the requirement, so 20% of a project had to be climate adaptation related in order for it to qualify for use of proceeds, means that it forced us to go through the details of the project and identify explicitly what is climate adaptation and quantify it. So it's a very healthy exercise, and I think it's one of the benefits of issuing a climate adaptation bond.
All right, I think we a bit over time, but it is kind of a great food for thought. So as said earlier, so we are here, like AIB is here at the COP to, of course, to celebrate, to share our experiences, but also more importantly, to hear the feedback and also advices, particularly for this adaptation. So, I mean, colleagues and friends, if you would like to discuss more with us, just feel free. And then last, and such a great panel and such a great discussion. So colleagues, please join me to thank our panelists for today's discussion and sharing. And thanks a lot. Thanks. Okay.